Obviously, real estate can be more than just where you live. So many people use that in their strategy for gaining wealth as well as retirement. So let's talk about it this week. Can real estate boost your retirement plan? Welcome into Phil's Tax Hacks and Other Retirement Facts with CPA and personal financial specialist, Phil Putney. Now let's get rolling with today's show. Hey everybody, welcome into the podcast. Thanks for hanging out with Phil and I here on Phil's Tax Hacks and Other Retirement Facts, where CPA and personal financial specialist Phil Putney helps break stuff down as to, this crazy, complex, simple yet super, troubling, complex world that is retirement. It's funny because, Phil, we talk all the time about, in so many ways, it is simple. And in so many other ways, it's massively complex, right? So it's a wild little thing that you got yourself into here, being a personal financial specialist.
Yeah, I mean, it's one of those things I think some people make it way too complex. I mean, it doesn't have to be that complex, but just its nature is complex, right? I mean, if you do it right, because there's a lot of aspects of retirement that you have to look at. And in our classes, I often put up what's called an anagram with the interlocking circles, where I always say there's three components that everyone has: income, right? Everyone's got at least Social Security, could be pensions. Everyone's accumulated assets, and we've always talked about those: the tax buckets, taxable, tax deferred, tax free. And you're going to need income. The third one is going to be your taxes. So how all three of those buckets work, as one changes, it changes the other, and it changes the other.
Yeah, for sure.
But at the intersection of all three of those is your plan, right? And everyone's plan encompasses those three, but looks a little different. So we've all got very similar components, but it's going to be what is right for you is based on your specific scenario. And it might be one of those components that fits in there. But
what is that? A Venn diagram? Is that what that's?
Or a Venn diagram? Yeah.
Yeah. So universal things that affect us all. Well, real estate, right? So let's talk a little bit about that. Obviously, we're going to have, the house most likely where you're going to live or condo or whatever it might be. But let's take a look at some, today we're going to break down some ways to use it or to at least think about how it fits into your strategy, right? So I guess we'll just start with secondary properties, rental properties, beach house, whatever.
Sure. Yeah. So, I mean, oftentimes I'll have clients come to me and we'll have the discussion on rental properties. And there's pros and cons, always my first reaction to it is, well, how did you find out about it? Let's hear kind of your viewpoint of what you've seen if they haven't already owned a rental property themselves. Because rental properties can be very good. There's huge potential in them. But there's also some risk, right? If they're not managed properly, or you just have the wrong tenants. And the real problem with rental properties surrounds around tenants.
Yeah, for sure.
Which, I mean, you can control to some extent, but it's, at the end of the day, they can tell you one thing. And, funny, we're talking about this. I've got a client that I'm working with now that they moved to North Carolina. They kept their house in Michigan and fixed it up and started renting it. And they've been doing okay with it, but they this year have decided, we're out. We're going to sell it.
Yeah.
Because they had a bad tenant, right?
We did the same thing. Yeah. We had a bad tenant one time and it was like never again. So
told them, oh no, we don't have a dog, and here's the parameters of the dog. And they had a dog and it was a big dog. And now it's destroyed like all the screens in the house and it's done. So now it's a huge problem. So rental properties, are they a good retirement vehicle? They can be for the right person.
It's around the income too, right? So I mean, you've got to keep you've got to keep people in it, paying you money.
Correct.
And B, you have to weigh in the factor of, all the stuff that goes along with it, fixing things or paying a management company and taking that out of the fee. So it's not for everybody, right? It's certainly, I think, like anything else, we've made it sexy on TV.
Yes. I think that's what most people get is they've got a buddy that's done it and he's done really well. And I mean, it's great. He's got $3,000 a month coming in.
Yeah.
From 6 different houses, whatever it is, so that sounds like a great thing. Let's put all, a bunch of our money over there and we can do this. And it's like, okay, that is one way it works. If it works really well, have you looked at, here's the hurdles in getting there. Number one, are you going to manage it?
Right.
Do you even have that ability or desire?
True.
If you're a handy type of person and you're going to go,
it could go a long way.
and this is something you want to do, then, I mean, it might be a good option for you.
Well, so
But,
since I mentioned that, let's incorporate rental properties with the. I'm going to jump on the list here, but house flipping, right? Again,
right.
that's television's made that super sexy, but
Oh, yeah.
with the market out there, the housing market, A, inventory's low, and B, are you going to get it at a price that makes flipping it worthwhile?
Right. Yeah. So going into the flipping, I mean, the big risk there is, do you really understand what you bought? So I mean, if you don't really understand real estate, right? You're in the construction world already, or you're already have been in the real estate world and know what to look for. Unfortunately, you can get yourself into a lot of problems.
Oh yeah.
And don't count on the inspector, right? Because at the end of the day, they point out some of the stuff, they miss a lot of stuff, and there is no liability to them. We've got a personal experience with this.
True, yeah.
Our son and daughter-in-law, when they bought one of their houses, their first house, inspector went through and said, "Oh yeah, it looks all good." And, they did it before we got a chance to look at it. When we finally got to it, it had some foundation issues.
Oh yeah.
Which, again, at that point, what do you do? Right.
Right.
And it could be a big problem long-term. So anyways, it comes down to, if you don't really understand what you're looking for or looking at, you can get yourself into a bad.
You're going to have to learn, especially don't sacrifice your retirement strategy for getting into house flipping as well. There was a house down the road from me built in the 50s, older, the property was nice, but they decided people bought it. They decided to totally renovate it. It looks fantastic. And during the height of the real estate, I want to say maybe a year and a half ago, in this area anyway, they listed it for $650,000. I want to say I think it was sold for like $350 or something like that when they got it, and it just set because people are like, now that the rates are high, because we started having the interest rates go up, and so it set. They wound up bringing it all the way down. I kept watching it just to see what happened. They ended up selling it for $499, right?
Yeah.
So I don't know if they made a profit or not, because I don't know how much they spent on renovating, right? So just
renovations, yeah.
If you're doing that as part of your retirement strategy, please do not get into that without being experienced, I think, in home flipping.
Yeah, I mean, that is the risk you face there. The markets are obviously something you don't control. And oftentimes, like it seemed like a great idea because this market was a hot market for real estate. Man.
Sure, yeah.
Always going up. You saw people buying and flipping and, catching this wave up, so to speak. Well, investing, same thing happens. Housing markets go through cycles too. So,
and if you tap out, you're tapped out.
We're near a peak, maybe, who knows?
Yeah.
But interest rates have definitely not played fairly to that market.
Very true. Very true. All right, so we're talking about real estate here this week on the podcast. So what about home equity lines of credit? And again, kind of bringing this back to, can it boost your retirement plan? So that was kind of the first angle with retirement or rental properties and house flipping. What about HELOCs? Yeah,
HELOCs are something I would recommend all people have in retirement. Not that they use it, but it's a great emergency fund.
Okay.
Now, I mean, now that banks are actually paying a little bit, it doesn't hurt to have some money sitting in a bank. But when they were paying you 0.01%, it's like, do you really want to keep $50,000 just there in case, right? So a HELOC is just an in case type of an account. Yeah, it might cost you $150 a year or whatever the renewal rate is for that loan each year. So there's a little bit of cost. But if it's the HELOC, the line of credit, as long as you haven't drawn money from it, it doesn't cost you anything. So it is or can be a great option when you're looking at that emergency fund type of scenario that, hey, I need to replace the roof. We just had a bad storm and I'm fighting with the insurance company, whatever it is, or whatever, your furnace goes out, trying to figure out how I'm going to pay for it. Just have the funds to pay for it. That's your emergency fund. Now figure out how to build that into the plan to replenish and get that paid down or whatever the case is. So.
Okay. All right. What about the interesting topic? I guess the annuity of real estate, which would be reverse mortgages, right? So much like annuities, they have a bad rep. They used to be pretty terrible products, but they've changed a lot, right? And so I guess depending on the scenario, I mean, I looked at it a little bit and I thought, if you do this right, this could be a great tool, especially for a couple with no kids, or maybe just one kid that doesn't want the house, or even if you have multiple kids, but no one has an interest in your house when you pass on, right?
Right. Or even if they do, it can still be a good tool. So, I mean, HELOC, to your point, it used to be a terrible vehicle because of how they were structured, that basically you were trading, your house equity for this stream of income. And if you didn't live very long, well, the mortgage company kept the house. It's kind of the original scenario. Well, I mean, since then it's highly regulated now, so that does not happen anymore. It is truly a mortgage, but it's a reverse mortgage in that you don't make a payment. So the interest accrues. It's not like you're not accruing interest, but you never have to pay that back, right? It ultimately would get paid back by the sale of the house.
So let's say they give you a $500,000, reverse mortgage, right? So they're going to recoup their money and this is typically when both parties when
both parties have passed,
right?
It's mortgage. The house gets sold, and
Now, some of them also do give the family, the heirs. Sometimes the heirs have first right of refusal, again, depending on the type of reverse mortgage you have. If they want to buy it, great, right? Yeah,
so in a reverse mortgage, it is truly a mortgage, right? Okay. It's not like they're going to come in and snatch the house when both parties have passed. Okay. It's a mortgage.
Okay.
When both parties have passed, the mortgage is going to be due. So something has to happen then, right? Either it's not going to be immediate. They'll work it out with you.
Right.
Either the house has to be sold so that it can be paid back, or if the heirs want it, well, they're going to have to refinance that mortgage and pay it off.
Right. Okay.
The point of a reverse mortgage anymore to me is it could generate income, right? So you can do a reverse mortgage where it's generating a monthly stream of cash flow, let's put it that way, versus income, because that's really what it does.
Yeah, to fund your retirement, or to shore up your retirement.
And that is a great use of it, because at the end of the day, your home equity does absolutely nothing, right?
Technically, that's true, yeah.
Well, the value of your house is going to do what it's going to do. It's going to go up and down. So that's irrelevant of what the equity in the house it is that you have. And this is where, it's comfortable not to have a mortgage.
Sure. Feels great.
Personal opinion. My personal opinion, I will never not have a mortgage.
Okay.
Because my home equity does nothing for me, because I'm not getting paid anything on that. It's just sitting there dead. Mm-hmm. So
the whole 2 inches taller thing doesn't apply to you. You get rid of your mortgage and you feel 2 inches taller, and all that kind of stuff. Okay.
No, because I'm just losing money on it, because it's equity that does nothing.
Gotcha. All right.
So there's the reverse mortgages are really coming around, where there's a lot of interesting factors to look at. And this is something actually I'm meaning to look at as we kind of further on here.
Okay. Yeah. Maybe we'll do an episode, a deep dive. Maybe we can do some research. We'll do a deep dive on an episode.
Yeah. How to better use them, and just better education, because I think at the end of the day, it's one of those tools that it's got bad rep, right? People look at it and say, reverse mortgage. Well, that's for the people that have absolutely nothing. They can't afford anything. All they've got left is the house, so they've got to spend the equity out of the house. That's one use for it, but there's many, many other uses for it, and it can actually be a very useful tool in an overall retirement plan. So,
okay.
Yeah, so there's a lot to go into with that.
Yeah, for sure. Let's definitely do a deep dive on that. That'd be interesting. I'd be interested to learn more. What's a 1031 exchange for folks that have heard this term but aren't sure what it is?
Yeah, so 1031 exchanges are, for instance, on the rental properties. So let's say you had a rental property, you've rented it, fixed it up, rented it for a few years, and you decided that you want to get out of that one and you want to go into a different one.
Okay.
So if you were to sell your first rental property, you've depreciated it over the years. So you paid $300 for it, and you've written it off. So now your basis, so to speak, is only $2, but you sell it for $4. So you sell it today. Now you've got this capital gain of $200,000, and the IRS now wants their share of that in taxes. So a 1031 simply allows you to, in its purest form, trade houses, right? So if you were to trade house A for house B, at the end of the day, there's no tax ramifications. You didn't sell it.
Gotcha. Kind of like when you move money from one retirement account to another, as long as you don't touch it, there's no it's not a taxable event.
Correct.
Okay.
There's no taxable event when you do a flip like that.
Gotcha.
But your cost basis just carries over. So even though the new place now was 400,000, well, you didn't pay for, you traded.
Okay.
So your 200,000 basis from house A just carries over to the new house. And
Oh,
you continue depreciating the same way. So you don't get this step up, so to speak.
right.
The only way you get basis is by paying taxes. That gives you basis.
Gotcha.
So that's kind of the downside to 1031s, but it allows you to use all the equity, right? Because I mean, if you, in the first scenario, sold it for 4, but you had 200 in gain and simple, let's say it was 20% gain. So you had to pay 40 in taxes.
Mm-hmm.
Well, now you don't have 4 anymore. You've got 360.
Gotcha.
Versus if you did the 1031, you've got the full 4 to go into the new house. And it's not as simple as that. You have to use what's called a qualified intermediary, which is a special third party, usually like a title company or a lawyer that specializes in this, that kind of acts on your behalf, that you effectively give them your house, and that they go out, they sell your house to the buyer,
Right.
take that cash in and buy the new house, and then they give you back the new house.
Gotcha. Okay.
So from your standpoint, you had a house A, you got a house back B. You never
Gotcha.
touched the money.
Yeah. Yeah.
If you get money back, then that's what's called boot, and now it's taxable to you. So that's, you got to be careful in
Interesting.
that. But anyways,
Boot. Okay. Yeah. So
Yeah,
again, kind of like custodian to custodian whenever you're moving
it's
stuff.
a great
Okay.
tool potentially to be able to flip houses from one to another and not pay tax on it.
The Tax Smart Retiree is your comprehensive guide to mastering tax efficiency for a flourishing retirement. You will find indispensable advice and actionable strategies designed to enhance tax savings, maximize Social Security benefits, protect against market volatility, and develop a customized retirement plan. To get your free ebook, click the link in the show notes of today's episode and download your copy of the Tax Smart Retiree right now.
All right. So it kind of definitely fits in that rental property or house flipping world.
Yep. Just a
that you
lot of
might find
nuances
yourself
you have
in.
to follow.
Yeah. Okay. I know we're getting a little long, so I'll do one more here just to kind of touch on it, and then we'll look at the commercial aspect, because most of what we talked about has been a little bit more, I guess, residential or that type of thing. What are REITs? What's your thoughts on REITs? I mean, with a lot of times I think about these things as being like, the strip centers, buying into a strip center or, shopping malls, things of that nature. I know there's other kinds, but just my quick analogy of it. And it just seems like with brick and mortar stuff dying, it seems like these could be kind of interesting, risky things,
You've got to be careful. Yeah. So REITs, Real Estate Investment Trust, is what they're, the actual name, but REITs is what everyone knows them as.
Yeah.
So it is nothing more than an entity, a corporation that is buying underlying assets of real estate. It can be 100 different types. I mean, you could have an apartment REIT that all they buy is apartments. It could be, anchor-centered REIT where they're looking at shopping centers that are anchored by a large store, a big grocery store, whatever it happens to be. There's like thousands of them. Storage REITs, I mean, you name it, they've come up with.
So it's kind of like a mutual fund where you're buying a portion of it.
It is. And there's many different types and how you get into them. The publicly traded REITs, I mean, that's purely just a corporation.
Yeah, because there's public and private REITs, right?
Right. You can buy them on the market just like you could buy any other stock. It's just a stock. It's just the underlying asset is real estate that, is then generating rental income minus all the fees and whatever. Then there's a net profit and then they generate dividends. And that in real estate is kind of where you've got to be careful, because they can generate a dividend, which a lot of times people think of as, well, it's profit.
Mm-hmm.
But in real estate, you can have and it's not technically a dividend, it's a distribution.
Correct. Yeah.
Where a part of that distribution is actually just a return of your own principal.
Is that taxable?
It's not taxable.
Okay.
But so there's no tax ramifications, and actually, it can be played off as good.
Okay.
But you're just getting your money back. Mm-hmm. Where the challenge becomes is if you look at a REIT and it says it has a 8% distribution rate,
mm-hmm.
don't think of that as an 8% dividend rate.
Okay.
Because in a stock, if it had an 8% dividend rate, that is truly a dividend. It's not like they're taking part of the company and selling it to give you that money.
Mm-hmm.
In real estate, it's truly equity in the real estate. They might have generated cash by selling a property or by borrowing money, right?
Gotcha.
So
Okay.
Generating cash that now they've distributed out. So I mean, it's just a nuance you have to understand with real estate. That the public side, the private side is where a lot of REITs start, where it's a private, non-traded REIT at that point. As they're kind of collecting the investment money and going out and buying these properties. And then ultimately those properties have an end goal of either listing where the REIT itself goes public and lists on an exchange where you can trade it, or a lot of times they'll end up merging, so they merge into a current publicly traded REIT where now you get shares of that publicly traded REIT for yours. So
gotcha. Is liquidity the big problem with these for people?
I was going to say the thing to consider, especially on the private side, is they are not liquid.
Right.
So it's not like the public side is a stock, right? If you need the liquidity, hit the button and it's gone, right? You can sell
the
it
stock,
like any other stock.
Yeah.
On the private side, you can't do that, right? So a lot of them will have a liquidation where the company is going to buy back certain number of shares per year. But depending on what things, what's happening in markets and in the real estate, they might shut that off. It's not a guarantee.
Yeah. You could be locking up your money for many years in these.
Right. So you could have money locked up that you can't now get out of because that liquidity event hasn't happened.
Yeah.
So, So just to understand going in fully what it is. It's a great exposure to real estate.
Complicated tool though.
Very complicated tool, and just be careful again, what is the underlying real estate, and then kind of make your own judgment on what you think of where that particular real estate's going. So,
okay. Well, so can real estate be a boon or a help to your retirement strategy? Again, I guess like any financial tool, Phil, it depends.
It depends. I mean, it is, at the end of the day, it's a tool, whether it's your own personal residence, and we're talking about a home equity line of credit, downsizing and moving somewhere else. I mean, there's all these different aspects that it's going to play into your retirement, or if it's more from an investment standpoint of, I'm going to do a rental property, do the flipping, do a REIT, whatever it happens to be. There's some options. There's some opportunity. Know what it is, how it works. Is it something you really want to get into? Are you comfortable with some of the complexities? And if it is, then see how it fits into your plan. So
and of course, always consider the taxation ramifications of any of these things. And any of the stuff we talked about this week, or any other show that we do, or any other financial thing you see out there, always check with a qualified professional before you take any action. Don't just run out and do something because, Phil broke down something and you're like, hey, that sounds awesome. It may be for you, but it may not be either, because we're talking in generalities to a wide audience. So always check with a qualified professional. Like Phil, sit down and have a conversation. You can find the links in the show description below. You can go to philstaxhacks.com to check out the main podcast page, but you can also redirect back around to his personal website and get yourself some time onto the calendar. And again, we'll have those links in the show descriptions below. Don't forget to subscribe to us on Apple, Spotify, and YouTube. We'll get out of here and let you guys get going. Thanks so much for hanging out. Hit that subscribe button, support the channel, and we'll see you next time here on Phil's Tax Hacks and Other Retirement Facts.
Phil?
Investment advisory services offered through AFS Wealth Management. The content of this program is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. Investments and/or investment strategies involve risk, including the possible loss of principal. There is no assurance that any investment strategy will achieve its objectives.